Most beginner traders use moving averages the wrong way. They add the indicator to the chart, but never actually understand what it's showing them. In this tutorial, I'll break down how moving averages work inside TradingView, how traders use them to identify market structure and trend direction, and how to avoid some of the most common technical analysis mistakes beginners make. A moving average is one of the simplest tools in technical analysis. Its main purpose is to smooth out price action so you can see the overall trend more clearly instead of reacting to every candle movement. And in financial markets, identifying trend direction early can help traders make better investing and risk management decisions. So let's jump into TradingView. Start by opening any chart. This works for stocks, crypto, forex, or most major financial markets. Now head over to indicators at the top of the screen and search for moving average. Select the simple moving average. You'll immediately see a line appear across the chart. This line tracks the average price of the asset over a selected period of time. Right now, the default setting may already be applied, but we'll use a 20-period moving average for this example because it's commonly used for short-term market analysis. To change the settings, click the gear icon beside the indicator. Set the length to 20. Now the moving average is calculating the average closing price of the last 20 candles. As each new candle forms, the oldest candle drops off, and the newest one gets added into the calculation. This creates a smooth line that follows price movement while filtering out some short-term volatility. And this is where moving averages become useful. When price stays above the moving average and the line starts sloping upward, it usually signals bullish market structure. That tells traders momentum is favoring buyers. On the other hand, if price moves below the moving average and the line starts pointing downward, it can signal bearish price action and weakening momentum. One common strategy traders watch for is a breakout above the moving average. For example, if price has been trading below the line and then closes above it while the average starts turning upward, some traders see that as a potential trend shift. Another common setup is called a support bounce. Watch this section carefully. Notice how price pulls back toward the moving average, touches it, and then starts moving higher again. In many cases, traders use the moving average as a dynamic support level during an uptrend. The same idea works in reverse, during downtrends. If price rallies into the moving average and gets rejected lower, some traders may interpret that as resistance. This can help identify possible sell zones or areas where momentum is weakening. If you enjoy clean and beginner-friendly TradingView tutorials focused on real market analysis, subscribe for more weekly content. Now, one important thing to understand is that shorter moving averages react faster to price movement. A 20-period average moves quickly, which can be useful for active traders. But there's also a downside. You'll sometimes notice false signals where price crosses above or below the line briefly before reversing immediately. This is known as a whipsaw. And during choppy market conditions, whipsaws happen frequently. That's why many traders also use longer-term moving averages. For example, let's add a 50-period moving average. Go back to indicators, add another moving average, then change the length to 50. Notice how the line becomes smoother. The signals appear slower, but there's usually less noise. Longer-term investors often prefer these smoother trends because they help filter out smaller market fluctuations. Now let's take it one step further. Add a 200-period moving average. This is one of the most widely watched indicators in technical analysis and institutional trading. The 200 moving average is commonly used to analyze long-term macro trends and overall market direction. When price remains above the 200-period average, many traders consider the asset to be in a long-term uptrend. And when price trades below it, sentiment is often viewed as weaker. Using multiple moving averages together can also help confirm trend strength. For example, if the 20, 50, and 200-period moving averages are all lined upward, that can signal strong, bullish momentum across multiple timeframes. But moving averages are not perfect. One major limitation is lag. Because moving averages rely on historical price data, they react after price has already moved. So if the market suddenly drops or spikes aggressively, the moving average may take time to catch up. You can actually see that delay directly on the chart. Notice how price changes first while the indicator adjusts more gradually afterward. To reduce lag, some traders use indicators like the exponential moving average, also known as the EMA. Unlike the simple moving average, the EMA gives more weight to recent price action, which allows it to react faster to changing market conditions. This can be especially useful in fast-moving crypto markets or short-term trading environments with high volatility and liquidity shifts. But regardless of which version you use, moving averages should never be treated as future prediction tools. They don't predict where the market will go next. They simply help traders interpret existing market structure, trend direction, and momentum more clearly. And when combined with proper risk management and price action analysis, they can become a very useful part of a trading strategy.